and welcome to this conversation about the oil and gas sector in Asia post-COVID. Before we jump into the conversation, I thought it'd be useful to kind of set the scene of the scale of change and transition and challenge, if you want to phrase it that way. Asia has been the point of growth for the hydrocarbon industry. This is where consumption has been growing more than pretty much any other region. Depending on source, you can estimate between 6 and 10% growth year on year for oil and oil products, versus the rest of the world has generally been flat, in fact declining in some regions. So within that context, if we think about how the pandemic is playing out and how demand destruction is playing out, we have a couple of proprietary models within Oliver Wyman that we've used to do some of this analysis. And what we see is that the headline is essentially something like the demand equivalent of India will be destroyed for the year 2020, which is between 15 and 17% of Asian demand, again, for oil and oil products. So whilst, yes, that demand is going to stay destroyed for longer, it is a smaller part of the portfolio. What is a larger part of the portfolio, though, is the on-road transportations. In fact, we estimate that gasoline could see as much as a fifth of its annual demand destroyed in this part of the world. I think if we kind of move forward a little bit in the value chain, refining, we walked into COVID recognizing that there was probably a refining overhang globally. But there were significant investment plans, particularly in Asia, which I think will now come under a lens because, again, go back to demand. Demand not being there means kind of the demand for refining capacity is also reduced. And so refining margins in general will be suppressed for a little while. And therefore, if you look at those kind of investment decisions, they suddenly look a lot more red than even 4 months ago.
Thank you, Abhi. I obviously agree with everything you just said. Demand destruction has happened, will continue and will remain for a while. And you have outlined various scenarios in such respect. From my perspective, I would say that these 2 months of June and July are particularly critical because we see happening two things at the same time. The first one is obviously an easing of the lockdown situation in numerous countries. And on the other side, you have also the supply cuts, which start to be quite effective in respect of OPEC, Russia, the oil majors. You have the shut-ins in the US, and also the natural decline on production in the US. So we will want to see how this market is rebalancing little by little, and subsequently how at the same time, how this demand will start picking up. I would say, in first instance, we will see more people driving effectively, maybe a bit more reluctant to use mass transportation unless if they have no choice. And the last bit will probably be in respect of airlines, jet carriers. We see a couple of countries where internal flights are happening. That's the case in China or in Vietnam. There will be different form of impacts, I would say. Let's talk about upstream first. All the majors, all the national oil companies, all the independents, IOCs have got the capex right now. So we may possibly see a situation 3 or 4 years where supply may be lower than demand, and oil prices effectively going up because of that. In respect of energy infrastructure, I think what happened on the LNG space was also and remains very interesting, because I think we have noticed the lack of such storage capabilities, in particular in Asia. With all the factories being down, of course, the energy needs are much lower, and all the imports of gas had to decrease. But at the same time, you cannot store as much as you could store oil, for example. And that's probably something which will also impact energy infrastructure in the future. Once more, COVID-19 will have consequences on a lot of areas. And I will be particularly interesting to see the effective effect in LNG, in particular in China, which has restarted very material imports recently.
So I tend to agree with you that this has shown the demands, the constraints around storage, right, in some of these geographies. There are certain economies here, for example, that run on 15 days storage, whereas most developed markets will have 30 or in excess of that days of storage. And so this, I mean, there's been a play on storage right now, an economic play, but I think it is also highlighted that there is a longer term play here on a build of infrastructure, folks that are retailers, independent sales entities in the absolute downstream end of this value chain that are not locked into long-term contracts, supply contracts, have the opportunity of creating more value for themselves in the short term, and I suspect in the next few months ahead. And then as we think about the kind of recovery, as it were, capturing customers will become a particular emphasis of whether it's the national oil companies in certain markets or the IOCs or independent.
Pursuant to 2015, we have seen a lot of transformation in that area, a lot more integrated refineries, complex refineries, where you are not only dependent on one or two products, but really on a panel of products. And the big winners from what's happening these days will be these integrated refiners. And as you just pointed out, those with a retail arm or the independent retailers will also be the one who, because in let's say, control of demand, will also benefit from their situation and capabilities. But definitely a lot of changes are expected. Transformation, modernization, and you want, as an oil and gas player active in that area, you want to be able very quickly, immediately, to recapture your market share, to increase your market share, and to come up with the most innovative solutions, I would say. So there are a couple of countries, just a handful these days, where there are attempts to to fill your petrol tank just outside your house. You use your app, and the petrol is filled. The petrol tank is filled a couple of hours later. The ones coming up with these ideas will probably be top companies of tomorrow.
I think that's absolutely right, which creates an interesting rupture at the point of the retail side, which has been a point of investment for the oil and gas companies thus far, right? The rupture because, yes, what does the retail side look like in the future where social distancing is expected? Now, you could certainly see a move towards the kind of models that you're talking about, or you could actually see a doubling down on the retail side where you're actually able to execute social distancing and how you interact with the customer there and use that as the basis to deliver more than just fuel, right? So it becomes an interesting strategic question for oil and gas companies of, can we be more than just agents of fueling someone's vehicle?
If I think about the energy sector and how it plays out in the financial services, I think there's both kind of a story of concern, but also a story of excitement and inspiration. The energy sector really within banking has been a fundamental key driver of growth. It's amongst the top 6 contributors of revenue in the banking sector in general. And it's a key driver of returns. If you look at some of the businesses that benefit from energy, you have structured trade finance, which is one of the most profitable segments of the overall transaction banking business. And clearly that then has, massive linkages to the supply chains, be it part suppliers for upstream or downstream. And then clearly off the back of that, you have all the project finance that goes into financing energy development. This is clearly going through a massive period of disruption. You do expect banks to retracting balance sheet from some of this sector, which basically means the sector itself is going to have to be much more efficient in how it utilizes its own working capital. This digital innovation is going to drive essentially massive efficiency, which is going to be key to the energy supply chain, given they're going to be much more reliant upon their working capital versus bank funding. And so they're going to need that. It also generates a lot of data that arguably can be much more valuable in how they actually tailor the B2C proposition, as Abby was talking about.
Each time there's been an oil crisis, and I've experienced 2, this is the 3rd one. and sometimes associated with big bankruptcies or scandals or frauds. The FIs, the banks are rethinking a bit their involvement on that particular sector. That was the case in 2015, and it will be the case again now. So the banks will rethink their involvement, so they can say, I don't want to be involved in that particular subsector or area in the oil and gas. Some others, on the opposite, will see opportunities to increase their market share. What has happened over the past couple of years, gradually, is change in the source of capital for all these companies. So even before COVID, but even more importantly, after COVID, we will see more and more sustainability linked law, green bonds. As a corporate, you need to evolving your governance in respect of ESG and your business approach towards your customers as well.
The sector is not going to be starved of capital. There will be people who will step in and fund it. It just might look very different than what it looked like today. But I do think you are going to see some banks fundamentally saying, I'm no longer going to lend to the sector. It just does not align with my ESG standards. And I think you're seeing that in Australia. But ultimately, I think it's going to drive very interesting innovation in the sector overall. One could argue it might not have seen something as profound as this, which is going to drive end-to-end innovation, as Abby alluded to, in B2C business. You were talking about new supply chain and digitization. You could find a sector that it could actually operate with 30 to 40% less working capital because it's found new ways to innovate, which basically means, the dependency on banks fundamentally, decreases.
Well, oil and gas will remain extremely important in all the economies. It will take a lot of time before the energy mix is changed materially before hydrocarbons share in this mix is going below 30%. It will probably take at least 15 to 20 years. At the same time, gas will continue being extremely important during this transition phase, in particular in Asia. The importance of oil and gas in economy and in energy will remain very important again for quite some time, which shouldn't prevent absolutely in any case doing this transition these days into renewable and green, of course.
So having been through that conversation, right, of baselining the industry, understanding how value pools are shifting and the interaction with the financial services space and investors changing, let's now talk about so what, right? So what does this mean for different models, different players? And I'm kind of reminded of the Mark Twain quote of the reports of my death are greatly exaggerated, because I don't see this industry going away, right? I see it in a period of transition. Now, if we talk about this change and this transition, right, I think of it in 4 layers. The first layer is around customer and how value has moved to the downstream end of the value chain. And so the question that will arise is, how do we strengthen that customer relationship? What does digital mean? What investments do we need to make in digital? It also means, what else can oil and gas companies do with customers beyond just provisioning of a molecule? Now, that line of thinking has been in play for a while. To my mind, that gets turbocharged in times like this, when there's been a period where the oil and gas companies weren't selling molecules to a bunch of customers. So it is, what else can we be doing? How do we use technology to deliver some of that? The next layer to me is, if I look more broadly at the value chain, I see 2, perhaps 3 themes emerging. Theme 1 is around commercial sophistication and trading, where I do see a number of players, national oil companies, some of the kind of mid-sized entities starting to look at commodity trading and slightly as a potential avenue to create incremental returns and to help in times of extreme volatility such as this. The other bit is, as we alluded to, around kind of refining and broader asset build out, right? The overall refining, yes, may slow down or its build out may slow down, but I see a bunch of potentially existing assets or new builds being repositioned, whether that's to kind of take part in a petchem play or kind of on the feedstock side. I do see some of that happening. And then the second bit around that asset play is around storage and logistics, which again, this time has shown that there is a real and an economic need and a payoff for having that kind of a footprint. And so I see some kind of interesting moves by a bunch of different players in that space.
Well, I think there will be quite a few consequences post-COVID-19, and this has started already. That was the case in 2015, and some lessons from them were learned and will be reapplicable, presumably, here. I think first, I want to address 3 points: M&A, upstream, downstream. On the M&A space, I would say there are opportunities for the stronger players to further enhance their business. Lessons learned from 2015 on the upstream were extensively on lowering cost of production, the wellhead cost of production in particular, and in putting a lot of pressure on contractors, offshore services, etc. We will see the same, probably not to the same extent, but it should be repeated again, I believe. On the downstream side, back again to the lessons learned from 2015, we should see more and more refineries being more and more integrated or complex, less reliant just to the handful of product. But anyway, in any case, it's also about rethinking your approach to customers. Looking back at 2015, the lessons learned, further investment, further M&A potentially, and becoming stronger.